Okay, so now we're actually recording, and again, I'll post this up. Okay, so a couple of things that I wanted to go over regarding acquiring the textbook. Okay, and what I'm doing is I'm just now publishing it. I didn't do it prior because I didn't want people to start to look and get confused and stuff. So I want to walk you through what it is you need to do. So you can see that under syllabus, there's this spring 2018 federal tax accounting that I am now going to publish, so you will be able to see it on your Canvas. And the ebook reader is now there, so you can access the ebook reader from the area there that's just under syllabus. Okay, but before you do anything, you will have to register for the class by clicking on that, and they're going to either ask you to provide their credit card. For me, it's going to just load it because I'm already registered. But for you, they're going to start to ask you to provide them some information, your credit card. Do you want to do the trial period? I think they give you a 2-week trial period or something like that. Do you want just the ebook and the access to Cengage Now version 2? Do you want to order the ebook? Excuse me, the loose leaf, etc. Okay, so you'll go through those different options, and then that will give you access. You'll register, etc. Again, it's taking me straight to because I'm already registered. You'll have to go through that process of registering before you get into Cengage, and they want me to change my browser, and I'm not going to. I'm like, hey, I'm the customer, come to me. Why do I have to go to you? They want you to use Google Chrome, I guess, which for you guys may not be a big deal. I'm old, so I don't like to change things. Okay, so I'm going to continue to use Explorer. But you see how the assignments are right here? And right now you have assignment for 3 chapters. Excuse me, 4 chapters right here. Okay, and we'll continue to build those assignments in as we continue to go through the chapters. Right now I've just got the 4. Okay, but that's all right because we're going to be a while before we get to these. So I would say, probably this weekend you should be able to do some things with homework chapter 1, right? Okay. All right. Any question on that part? Okay. Now what I'm going to do is close this window and show you how you will access your homework going forward after you've registered. Okay, so what I just showed you is just how you get in to do the registration. Okay, going forward, what you will do is you'll come to assignments, and I'm going to go ahead and publish the assignments now. I just didn't publish them sooner because I didn't want you guys to get in there and start to get confused and start saying, I don't know what's going on. So you see the assignments now are now published. So you should be able to see those on your Canvas now. Okay, well, I should say once you've gone through the registration process, then you can see the assignments, and you go ahead and you click on, say, homework 1, and now what it should do is take you to Cengage. Go ahead, make a liar out of me. Really? There it goes. Okay. I have no patience for software that doesn't work. Okay, and you may have to click that, but it's just now taking you, right? Oh, it's a new window. It is. What am I supposed to hit next here? No, that'll take me to 2. Well, let's try it for homework chapter 2 then. Maybe I have to say allow. No. Start assignment. Okay, it didn't work for assignment chapter 1, but maybe that was just a temporary glitch. But you see that you have the homework assignment here, right? And this one's obviously a true-false question. And if you look at the number of questions here, it's 150 items. Okay, now before you panic, okay, say, really? I got to do 150 homework items to get, and it's what, 1.4 points per chapter. 1.4 points. You got 150 items, right? But the way I've set this up is you get credit for doing it 1% correct. So if you do what? whatever 1% of 150 is, you do 1.5. You get 2 items correct, you'll get the points. You'll get the full amount of the points. So the idea here is for you to have access to as many things as you want in the homework. Or I shouldn't say as many things as you want because they limit me at 150. There were more things that they made available that they have in here that I couldn't give to you because they stopped me at 150. Okay, so 150 is the max they'll give me. So you'll have 150 homework items that you can go ahead and look at and decide, what value you're getting out of these. If you look at a few true false questions and you say, hey, I don't like these, you can continue to scroll through and pretty soon you start getting multiple choice questions. All the different things that are in here, you can go through and take a look at and try those. Okay. Now, once you go ahead and you submit the assignment for grading, it'll say, are you sure you want to submit for grading? Yes, submit for grading. All work is saved, and I'm going to put us in student view here. I guess it's not going to let me do that either. View assignment results. Let's just look at that. And this assignment, number of attempts, 1. You have unlimited attempts. You can work it as many times as you want. And we say we're done. Oh, I see they didn't give me the results because I didn't try any to get them right. So let me try to get some right. Let's see. I'm just going to guess here. True. False. I don't know the answers to these. True. False. False. True. True. Okay. Now I'm going to go ahead and I'm going to submit the assignment for grading. Submit for grading. You can do this as many times as you want. There's unlimited attempts. So view assignment results. And notice it says I scored 100% on this. Now that's not because I'm, some sort of clairvoyant and I guessed without looking at these. I got some of them wrong, but I got enough right that I got 100% of the points. So again, I must have gotten 2 right because out of 150 you only need to get 1.5 correct in order to get the points. But you can go through as many of these questions as you like. Okay, they're all there for you. Okay, so that one I must have gotten correct, right? I got it correct, and it gives me why I got it correct. This one, I got it wrong, why I got it wrong. So it must be, see, I got 2 right, so that's why it's saying I got 100% correct on it, or 100% of the points, not correct, but 100% of the points because I got 2 right. So you go through the homework like that. That gives you everything that's in the textbook in terms of homework that you can work. You can take a look through those, see which ones you think you might want to try, etc. Okay. The other thing I will do is I'll post the solutions on Canvas. I haven't done that yet, but I'll post the solutions to the questions in the back of the book. So you can also sit there and see what the solutions were to the questions in the back of the book, and you can work through those. Okay. And then, as I said, I don't know if we're going to have a student assistant, but if we don't, I will come in on Fridays and we can go through selected homework questions that you want to look through. Okay. Our primary focus in this class is going to be slides and the quizzes that I put up on the on Canvas for each chapter. Slides, quizzes. That's how we'll do that. For example, today we'll get through chapter 1 slide and chapter 1 quiz today. Okay, I'm thinking we'll have enough time for that. Okay, and then we'll go chapter 2 next time, etc. So we won't be doing the homework together in class, but I put it all there for you so that you can work with it as much as you want. Okay, and then you've got the ebook. You can get the loose leaf book through Cengage. Question on any of that? Question on anything in here? Okay, good. So let me close that. And let me look at the assignments again. Yeah, they're still there. So you'll be able to see them like that after you register. Um, what else? Oh, grades. So you will see your grades populate in the grade book. So after you've gone through and you've gotten 1% of the questions right, the 1.4 will show up in here. Okay, so what I'll be doing is when I do your grades, I'll be looking, and if you have the points for 1.4 for that, fine, you get those points. If you don't get a 1.4, that means what? That means that you didn't attempt the homework, you didn't get the book, whatever it was, you decided to sacrifice 1.4 times, I think it's 22 chapters we're going to cover. So you would lose, what, 22 points? And I'm promise you, since we're on a curve, that what will make the difference between going in and at least doing that and not will be the difference between, minuses and pluses in the grading. Because I'm assuming all of you are going to do well on the exams. We're going to have a grade distribution that's skewed towards the high end. Okay, and so the points for the homework and the points for the quizzes that we'll do together. And I'm not going to take attendance today, but I will start taking attendance on Tuesday. If you're not here, you don't get points for the quizzes. If you're here, you get the point for the quiz. Okay, so those two factors, don't underestimate. I had a lot of students that were upset with me last semester because they said, hey, it's not fair that I'm, getting a B in the class when my score was 88. I should be getting a B plus. And I'm like, well, you would have got a B plus if you had gotten those those quiz points. You would have been up in the B pluses with the B plus people. Okay, and the answer to, not to having it more of a normal distribution where a B is an 80 or something instead of an 85 is to make the exams harder. And if I make the exams harder, I feel that you start not learning the material as well, because now all of a sudden you're taking, tests that are making you jump through hoops backwards instead of forwards or something, and we're destroying the learning process through the testing process. So I'd rather have the exams be straightforward, have the scores skewed towards the high end, and use the curving system to keep us under the 3.6. What is that, a maximum that we have? Okay? Unless you want me to make the test hard. I can make the test impossibly hard. I can have you weeping openly while you take the test, if that's what you want. Your decision. That's a cue for talk to me. If you want to make the test difficult, I can. Okay, I'll take that to mean you want them difficult then. So I'll make them as difficult as possible. Oh, okay. So we'll go. Okay. Okay. So we'll take that as an emphatic that we're gonna go ahead then, guys. And I'm not gonna make them like what does T in tax stand for? I'm not gonna do that. But I'm gonna make them very straightforward along the lines of what we're gonna see in the quizzes, right? So that there's no surprises on the test. Hopefully. Okay, but that means like an 85 could be a B, right? As opposed to a 65 being an A. I like that better, I think. Okay, all right, so let's go ahead then and let's stop with the administrative unless there are any other questions on, and I'm going to go all the way out. It's okay. In terms of what's in B courses at this point. No? Okay, guys, if you run into problems, by the way, I may not be able to help you. I will put tech support number for Cengage up here somewhere. That's another thing I want to put up here. So I'll put their tech support. up here, but be advised they get an F in tech support. Once you get on the phone with the right person, they're beautiful. That often means a 45-minute wait to talk to somebody who can't help you, and then a 30-minute wait to get to the person who's competent that can help you, which to me is ridiculous. Okay, but McGraw-Hill is killing everybody when it comes to the tech support. But we decided we want to use this Cengage book. So, okay, all right. So hopefully you'll go smoothly for you. Okay, so I'm going to go ahead and I'm going to open up the chapter 1 slides, and I will also open up the quiz that's here. Okay, so if you have that access to that, you may want to get that on your tablet. If you printed it out, you want to break those out so you can make notes as we go along. All right. And so let me just click over here. Something tell me this isn't recording. Yeah, it stopped recording for some weird reason. This thing is ridiculous. No, it's still recording. Okay, hello. All right, good. Okay, so let's take a look at chapter 1. They've got this little slogan for chapter 1. The only thing that's certain in life is death and taxes. I'm sure you've heard that. I forget who said that. I won't have a slogan for every chapter, but for the first one, I was in a good mood, and so I went ahead and put that up. Okay. Now, just taking a look at history of taxation in the United States, and basically, um, the federal government relied on customs duties and excise taxes until around 1913 when they decided to start trying to tax, or did pass a amendment to the Constitution, the 16th Amendment, that would allow them to tax income. So up until then, federal government needed revenue. It got it through, say, duties. Okay, you're going to be importing something from another country. They're going to make you pay a duty on that, right? Okay, and customs, which is part of the Department of Homeland Security now, is responsible for inspecting the goods, making sure you're not bringing in contraband, making sure you're paying the appropriate duties, etc. And mostly what customs does is rely on deterrence for violating the duties, and that they'll charge you 8 times the amount of what the duties would have been if they determine that you're trying to hide the paying the duties. So don't try to smuggle anything in, etc. You pay those taxes, right? Okay, and that's still the case, and that was really how they relied on revenue for all those years. They had a small time there where they're imposing income tax in order to fund the Civil War, but the 16th Amendment is what ultimately caused them to be able to tax you. And I think 16th Amendment came in about 1914 or something like that, which sort of coincides with World War I. So they probably figured, hey, we're going to need to be taxing during wartime, and pass the income tax amendment to the Constitution. Okay. Now you take a look, and there have been several revisions to the codes. Big ones are what's up here, 86 being the last one before the change in the tax code to what? 2017. So now you have a change in the tax code that will be labeled the 2017 change, and that's a big one. Okay, that's a big one. We will not be studying this code in here. We're going to be sticking with the code that has been in place since 1986, since companies will be filing their taxes in April 2018 under the 86 code. Okay, if we were looking at this material towards the end of beginning of 2019, I should say, then we'd be studying the 2017 code, but that's not really in effect. Now, having said that, doesn't mean I'm going to ignore it. I'll point out key provisions that are different from some of the things we're studying, but in terms of the detail, we're going to be sticking with the 2017 laws, the 1986 code. Okay. Now we take a look at the sources of income tax for the federal government, or the sources of taxes, I should say, for the federal government, and notice that individual income tax is the driver of the revenues that the government gets. How much revenue does the government get each year? Huh? A lot? Not enough. That's right. They get what? They get about 2.1 trillion in taxes, but how much do they spend of that? All of it, and then they spend some more, right? So they end up spending about 3.5 trillion dollars each year. They only get 2.1 in taxes. So what happens is they end up each year with something called a deficit. And the deficit is about 1.5 trillion each year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. About 1.5 trillion each year. And they sit there and they fight over this every year, but they always end up passing a budget that will guarantee that they will spend more money than they'll take in, right? I mean, they budget it that way. Right now, I mean, this is not a governmental accounting class, but right now you may want to keep an eye on what's going on in Washington, and that they're talking about shutting the government down, and it's because they can't agree to a lot of different things, and so they're not going to pass the 13 appropriation laws they need to, so that they can spend money appropriately for the different programs. They still will collect money from your check. They'll still collect the tax. So sometimes people think, you mean the government's bankrupt? That's why they shut it down? No, they have money, but they just can't agree how to spend it. If they can't pass the laws how to spend money, they go ahead and they shut the government down, and they may actually do that on Friday. We'll see if they can come up with something. But they decide to spend this 1.5, or they spend 3.5 trillion. They end up with a deficit of 1.5 trillion, and at the end of, I don't know, probably about 30 years of doing that, you end up with something called the debt. So right now the government has a debt of how much? Anybody want to try to guess at that number? The debt. Right now, they have a debt of 21 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay? Now, they sit there and they want to always blame that on Obama, because when Obama got out, it was at 21 trillion. But when Bush, the son, got out, I'll call that Bush sub 2, okay, it was about 10 trillion. When Clinton got out, I don't have to put a 2 next to him, or a 1 next to him, because we didn't get a Clinton 2. It was about 5 trillion. And when Bush the father got out, it was about 3.5 trillion. And when Reagan got out, it was about, I think it was maybe about either 1.5 or a trillion. I'll only give the man credit for 1 trillion that he put on. All the years before that, it was down in the low 100 millions. Okay, so this is a fairly modern 1985, 86 type thing, in which we started lowering tax rates, but continued to do what? Spend the same amount of money on social programs, increase social programs, finance wars, all of this stuff. Remember the Civil War, they had an income tax there to finance the war. We had the start of taxes because World War I was starting up, right? Okay, but of income taxes. But during the 70s, you can see that the rates were what? The rates were pretty high. I mean, they were around 74% financing wars, etc. It wasn't until the 80s that we sat there, lowered taxes, and continued to spend at the same rate and often increased the rate of spending significantly. And it's, I'm talking about war, but also we're right now in the midst of the longest running war ever. Okay, so usually wars are what? Okay, a couple, 3 years. You have them, you're over with. You don't get mad at anybody for another 10 years, right? Now we're sort of in a constant, never-ending war in Afghanistan and Iraq and all that kind of stuff. And so we keep piling up costs on war. We have an aging population, so we have social programs that keep piling up. Meanwhile, the taxes, what? Keep going down on a real basis, keep going down over that period of time. And so you end up with this huge deficit year after year, and you do that year after year after year, and all of a sudden you look up and you got a debt of 21 trillion. Okay, the new tax law, they're saying, will add another 1.5 trillion onto the deficit. So it's going to double the deficit over the next coming years. And if at the same time you're sitting there and saying that you're going to build up the infrastructure, you're going to build up the defense, all the things you hear talking, that will cause that debt, and taxes are going down at the same time, that will cause that debt to go even higher. So hang on. I don't know where we're going with this thing, but this is clearly a problem because you have to pay interest on this. You have to pay interest on this, and it's starting that more and more of the deficit each year is being caused by simply the debt service than it is paying for programs, paying the interest on the debt, than it is for paying for programs, etc., that we might think are beneficial to the society. Okay. All right. So that gives you a sense as to the different sources of the tax. Okay. Now, going back, there are some what they call, I guess, canons of taxation. Okay. You see somebody shooting a cannon and telling us equality. Okay. So what equality says is what? That there should be equality in how we tax individuals. It should be fair. Convenience, okay? We don't want individuals to have to go through so much trouble to pay the tax that they finally throw up their hands and say, forget it, right? And we're all sitting here in this class and getting CPAs and that sort of thing, probably because we're not really sticking to that canon too well, are we? And that we're going to see that there are complications here that cause people that in order to comply with the tax law, they have to start hiring individuals like yourself to help them to file their tax. Okay, certainty. Only thing that is the only certainties in life are death and taxes. So I think we've accomplished that. Effective tax administration. This is the burden on what? This is the burden on the government. Okay, the burden on the government. And sufficiency. Do we have sufficient tax to fund whatever as a society we've decided we're trying to finance? Okay, so just looking at these a little more closely. Equity. Each taxpayer enjoys a fair, equitable treatment. Certainty. Okay, we should pretty much know what our taxes are going to be, what the tax rules are, etc. Sufficiency involves assessing the aggregate size of the tax revenue that will help us meet our social objectives. And effective tax administration, tax compliance, and administrative costs should be kept to a minimum. But these are things that we try to accomplish with the tax. And, when Congress is passing tax law, they should keep these canons, which have been around for a long time. Who's this? Adam Smith? Okay, you've all heard of Adam Smith, the guy who talked about economics. I think he sort of had a little bit of a communistic way of looking at the way taxes, the way the economy should work. But workers of the world unite, all that stuff. Okay, but he had these canons of taxation. Okay, now when the federal government is establishing tax law, they're looking at economic objectives. Remember, we talked last time. We'll learn that they'll allow you to deduct as an itemized deduction the interest on your home loan, because what? They want individuals to buy homes because that helps to drive the economy. Okay, promoting certain activities, lower tax rate if you're married, so they want you to get married, right? So I guess that'd be more of a social. Promoting certain activities might be allowing deductions for charitable contributions, that sort of thing. Social, I guess you could probably put that there. And then from time to time we have tax reform, and that's really what we had here. Although they didn't call it tax reform, they called it tax cuts. Tax reform technically means that you do something that is revenue neutral. Okay, so when we say revenue neutral, we're going to pass a tax law, and we're going to say that we're going to allow additional deductions for certain activity. But if we allow certain deductions, the tax revenue will go down, right? So what do? We'll go ahead and reform the taxes in such a way that revenue will come up from a different source, but it's revenue neutral. They call that tax reform. Okay, the reason they didn't call this latest big change tax reform is because it was not revenue neutral. It increased the deficit, so that's why they called it the Tax Cut and Jobs Act, and they put the jobs on there so that people that are thinking, oh, okay, well, I'm going to get a job now because of this, so it's good, as opposed to just a tax cut for whoever. Most analysis will tell you that the tax cuts that are in this latest tax code benefit wealthy individuals more than they do sort of middle income individuals. So even though they cut the rates across the board, we'll see that in a second, they cut the higher rates, and of course if you have a larger amount of money with a smaller percentage, you're going to have an absolute dollar saving that is more towards the higher ends. The other thing that they did was they eliminated inheritance tax. Okay, so what happens? When you inherit money from your family, from your parents, whatever, there's a tax on that. And what they've done is they've lowered the threshold as to when you will be taxed. So it used to be that you could pass down to your heirs $11 million tax-free. Now they've upped that to $22 million tax-free that you can pass to so they doubled that you can pass to your heirs. And over time, I think it's like a 10-year period, they're going to completely eliminate the inheritance tax. So, Zuckerberg's kids can inherit his entire fortune without having to pay any inheritance tax on it. So I don't know if that helps anyone in this room. If it does, that's great. That means that you're going to be inheriting $11 million more and not paying tax on it than you would have anyway. Okay, but if you're not planning on inheriting $11 million, you might not like that provision of the tax cut that they talked about. Okay, but if it's revenue neutral, then they call it tax reform. Okay, all right, so we're going to be messing around with the tax formula, which is we'll take a tax base. That's going to be the amount of income using the tax law that is taxable. We will go ahead and multiply that by a tax rate, which again is basically a progressive schedule that will show us what the rates are based on your income, and then that will generate a tax liability. Okay, so when we talk about this tax base, we are talking about taxable income. Now you look at that and you say, well, taxable income, John, isn't that basically the amount of money that I made in a given year? Well, taxable income is what's left over after we consider some revenues that are simply not taxable, after we consider certain deductions like the interest that you pay on your home, etc., is deductible, and after you make those adjustments to your income, you end up with something called your taxable income. You'll multiply that by the appropriate rate, and again, it's a graduated scale that goes up. The more you make, the more you are taxed, and we'll look at that in a second. Okay, so we will go ahead and take a look at the tax rates. Okay, now there are some taxes that are considered proportional. Okay, so when we look at proportional tax, you can see here that proportional tax, I got to change the highlighter. that a proportional tax is the rate of tax remains constant for any given level of income. Okay, and they say examples of proportional taxes. They give you some examples here. FICA, for example. FICA is your Social Security tax. Okay, and FICA is a certain percentage of your income, and it doesn't matter how much you make up to a certain point, they're going to take that percentage. So they don't change it because you've gone up in your income. Now, the only thing about FICA is that it has an element in that it caps out at a certain level. So once you get up into the 90,000s of your income, they stop taxing you for the Social Security. But up to certain limits, it's something like 7.5% of your income is taken. It doesn't matter how much you make. Okay, the income tax is going to be considered progressive because what? It taxes you more the higher your income is, and so that would be called a progressive tax. Income tax is progressive. Okay, so let's just go ahead and let's take a look at this example. And by the way, you see example 1 and you say example 1 relative to what? What I've done with the chapters is I've picked out prose from the chapter, so you'll see this right in your textbook. And at the same time, I've picked out certain examples that are in the textbook, and you'll see them in the text as well. But let's just take a look at this one. Assume a jurisdiction applies a 30% tax rate to all taxable income. If Bill has $10,000 of taxable income, he will pay a tax of $30,000. If Sam has taxable income of $50,000, then again 30%. So even though it's more tax, it's proportional in that we apply the same percentage to that tax base. That's called a proportional tax. Okay. Question? Okay, good. So let's go ahead and let's take a look. And again, same information. A tax is proportional. We saw that. And then going over and just continuing on after that example, a tax is progressive if a higher tax rate applies as the tax base increases. And again, income tax, federal income tax, all these different taxes are considered to be progressive. The more you make, the more you pay. Okay? Is that fair? That the more you make, the more you pay, or at least a higher percentage? I'm asking, I'm not telling you. It's fair until what? Until it affects you, right? Then it's not fair anymore. Okay, so may you have to pay progressively higher taxes. Okay, is my wish for you, because that means you're making more money, right? Okay, but that's the way it works. Is it fair if we don't tax? What if we got rid of the inheritance tax altogether? Is that fair? The inheritance tax, just get rid of it, which they're planning to do, by the way, over the next 10 years. They're going to get rid of it. Is that fair? Just get rid of the inheritance tax? Sometimes they call it the death tax because they want to, make you feel bad about it. Death tax? You mean I can't even die without being taxed? Is that fair? Why do they even impose an inheritance tax? Why even impose an inheritance tax? Why do I have to pay tax to hand my money to my kids? I earned it. Well, yeah, that's how you can get it. Just because something is allowable under the, economic tax theory, law, etc., that doesn't mean that you have to tax it, though, right? So, yeah, it's fair under law. It's not unconstitutional. But notice Congress changed the law so that they're going to tax less and less of that, and then eventually not tax it, right? So it doesn't mean that you have to tax it because it's income. It's that you can tax it, right? You can set those tax rates wherever. So what do you think? Is it fair that I got to pay a tax to hand the money to my own kids? What do they call that? The fruit of your loins, whatever. Okay, you got to sit there and you got to pay tax for my little kid. My little 43-year-old kid. I have to. Okay. I mean, the idea here is what? The idea is that we don't believe in accumulation of wealth generation after generation after generation, and so that all of a sudden you end up with a society in which what? In which, say, 1% of the people hold 99% of the wealth. Oops, too late. Never mind. Okay, so, I mean, we already have that, don't we? But that consolidation of wealth will increase if you maintain a tax structure in which there's what? There's no taxation of passing of wealth from from one generation to the next. Simple mathematics will tell you that over time you're going to have that sort of a concentration of wealth. So, okay, anyway, that's that. Okay. Now, a regressive tax structure, the tax rate decreases as the tax base increases. And so when we look, we talked about the FUTA tax, the Social Security FICA tax, I should say. FUTA is federal unemployment tax. The FICA tax is proportional up to a point. And that what? After you go past that certain level, whatever it is, 90-something thousand of income, then it becomes what? A regressive tax, and that they stop taxing you as your income levels go higher, and what? And they continue to tax you if your income levels are lower. So as you get to a point where they stop taxing you or they tax you at a lower rate when you go higher, is considered a regressive tax structure. Okay? So we pretty much have this, don't we? Progressive tax, okay? But there are some taxes that could fall into the aggressive, okay? Now, you take a look in current law, and the tax rate schedules that we're going to be working with are here on the left, okay? And you have things like standard deduction that we'll talk about. We have personal exemptions that we'll talk about, okay? Now, you take a look. And what they've done is they have increased the standard deduction but eliminated certain personal exemptions. For example, if you're blind, if you're 65 years old, they'll give you a personal exemption, which they currently are doing that for 2018 and beyond. That's been eliminated. Notice the tax rates. Okay, so the tax rates have what? Have come down, and the amount that they will tax is also coming down. Okay, so you take a look, you can make a little bit more, a little bit less, I should say, a little bit more is what I want to say, a little bit more, and not be taxed at all, right, under the new tax law. And then the rates have come down in many of the categories. So you can make a little more and be taxed at a lower rate, right? So that's why they're calling it tax cut. The highest rate is now 37%, and it's on a higher dollar amount. Standard deduction has been increased. Okay, now this helps individuals sort of in the Midwest, that if you increase their standard deduction, then they won't have to do something called itemized deduction, which we'll study in Chapter 10. In order to get this nice deduction, they just don't have to itemize anymore. Now, if your itemized deductions are more than your standard deduction, then you would go ahead and do your itemized deductions. Okay? Now, itemized deductions, and again, I'm jumping ahead to later chapters, include things like interest on your home is an example of an itemized deduction. The state property, local property taxes that you pay, we don't have a state property tax in California, is deductible as an itemized deduction. Okay? Your state income tax is deductible as an itemized deduction. So let's just compare Mississippi and California for a second, okay? And I love Mississippi. I've been there. They're very nice. I was scared when I was going to Mississippi. I figured, 200, whatever much I weigh, 30, 40 pounds. I don't look anymore. Okay, bald-headed Puerto Rican walking around Mississippi. I'm definitely not going to melt into a crowd, So I'm thinking, geez, they're going to say, you're not from around here now, are you? But, geez, they were nice. I mean, beautiful people. The Gulf Coast of Mississippi is beautiful, okay? So anyway, I had to go there for work, so maybe they had to be nice to me because I was auditing them, but whatever. So, you go in there. Mississippi, and property values are fairly low, aren't they? So what's going to happen? Your property tax is not going to be as high, right? The what? The loan that you might have taken to buy that property is a lower loan, so the interest is going to be lower on it. You're probably making what? The reason the property values are so low is that the wages are not as high. So your state income tax is not going to be as high. So the chances that what? That you're having itemized deductions that exceed the standard deduction are less likely, aren't they? Okay? Lower income, state income tax, lower property taxes, lower interest on your home loan. Okay, compare that to who wants to pick a community in the Bay Area? Okay, since we're in Berkeley, we'll pick Berkeley then, right? What's happening? Your property value is a lot higher than it is. You take the same house in, the cost of the homes that you see a home 1.5 million, you're paying for the land. You're not paying for that house. You're paying for the land. What happens? You take that same house and you put it in Mississippi, they'll sell it to you for $500,000. Over here, you're going to have to pay 1.5 million, so you're going to probably have to do what? Take out a bigger loan. So you're going to have more home interest that you could have deducted, but now they're sitting there and they're doing what? They're telling you that you can only deduct so much, up to $10,000 of interest and up to $10,000 of itemized deductions, period. So your interest, your property tax, which is going to be higher in California, you can't deduct that now when it's in excess of $10,000. The interest on your loan, you can't deduct. Oh, you're probably making more money, aren't you? So your income tax, your state income tax, you can't deduct once it exceeds $10,000. Okay, so what they've done is they've done what? They've reduced the amount of itemized deductions that you can take in a state like California. So they're punishing California, aren't they? With the tax law? Why? Why are they punishing California? What did we do to them? Why punish California? What did we do? They want us to pay more tax, don't they? Why do they want California to pay more tax? Now, some people might... Go ahead. I mean, we would have paid more tax by virtue of the fact that we have higher income, so we're more towards the top of even a reduced tax rates, right? But now they've done, certain structural things with the tax law that will cause us to pay more tax on a percentage basis, right? Than say, I'm not picking on Mississippi. Anyone here from Mississippi? I'm not picking on Mississippi. I'm just saying, the way the economy is in Mississippi versus California, we have to pay a higher effective tax rate than, say, Mississippi would, right? Politics, guys, did we vote for, are we a blue state or a red state? Blue state. So, the state that we affiliate with, the Democrats, isn't in power, is it? So they were able to pass a law that did what? Hurts the blue states, helps the red states, right? Okay, and I'm pointing this out not to drive home, any political ideology, but just to show you that when we look at the tax laws, it gets a little bit frustrating because you're going to see all this weirdness. Well, you can take this standard deduction, or you can take this itemized deduction, but you can't take these things, you can't take those things. You're like, what are they doing? Why are they doing this? What the heck are they trying to accomplish? And it's what? It's some of those things that we saw up here in these sort of, social, economic, tax reform, etc. But it's also what? It's also politics. It's also politics. It's getting enough people in the Congress to vote for this. You have 100 senators. You have what? You have over 500 House members, and certain individuals won't vote for things for different reasons. And to try to cobble together enough people to even pass the stupid law, you have to what? You have to please different people, and you end up with somewhat of a, in terms of the simplicity can, and I don't know that we will get there as long as we're trying to do what? The convenience factor. I don't know that we'll get there. Okay, even though they talked about being able to put the taxes on a postcard. I don't think so. I think they've made things more complex with the changes, okay, which is good news for us because now they need to hire us to go in and do their taxes, right? Okay. Okay, good. So let's just take a look at the tax rate schedules. Okay, now there's two different ways to determine what your tax is. One is called a tax table. Okay, and with the tax table, they say if your income is between this amount and this amount, here's your tax. And you can just go ahead and plug in that number. Those tax rate tables are not as accurate as the tax rate schedules. So we're going to study the tax rate schedules and how to use these. And they're really easy, okay? But here's the 2016 tax rate schedule. Here's the 2017 tax rate schedule. And you can see that we break these out by different filing status, which we will study next time, okay? But if you're single, you pay a certain rates at certain levels of income, okay? And this is the current 2017. This is not the tax reform or tax cut and jobs schedule. This is the current schedule. If you're single, you pay certain amounts. If you're married, filing jointly, okay, at some point you start paying you pay lower amounts, okay, based on your levels of your income. So they have the rates, they have the levels of the income. Head of household, they give you a little bit of a better break. Married filing separate is the worst schedule. Okay, they want you to basically file a joint return with your spouse, even if you are estranged from them. They would like you to find them to file your taxes, okay? So the last time I saw my ex-wife was to sign off on tax returns, and that was the last time I saw her. This was years ago when I had hair back then, okay? But it was going, and I think that's why she didn't want. That's why she wanted to end the marriage, because I was losing my hair. But anyway, so what happens? I'm just kidding. The truth is, she found somebody else. But anyway, and he had a full head of hair, so I don't know. Okay, so anyway, way too much information, right? So what happens? You want to file jointly, because if you file separate, they're going to really hit you with a higher tax rate, okay? So the highest tax rate is married status. Filing status is married filing separate. The next highest is single. Then you have head of household. Head of household is if, your spouse dies and they give you a couple years to still file married. And then after that, you're maintaining a home for your children, okay, whatever. Then they'll give you not quite as good as married. So they give you 2 years to find somebody else. And then they start to tax you at a higher rate. Or if you're providing a home for your parents, something like that, then they'll let you file head of household. And then you've got married lowest, head of household next lowest, single next lowest, highest is married filing separate. Okay, but we'll get into that next time. Again, I kind of keep creeping into later subjects here, but notice they give you a range, okay, between 18,650, but not over 75,000, and then the amount that you are over the lower end of the threshold, you have to pay an additional percentage. So they give you what the tax is, plus what you have to pay for the amounts that you are over the lower end of the threshold. And you notice that the more over the threshold you get, then the more you're going to pay in terms of a percentage. Okay, so let's just go ahead. We'll practice with that here in a second. I just want to keep you in mind, we're not going to get to corporate taxes until much later, but we are going to talk about corporate taxes, right? And you can see that on the current structure, you have these progressive rates for corporate income at the highest levels being 35%. So a company like Apple's probably around 35% is what they're paying, right? But you come over, and they have changed that under the new law so that you were sitting there, and they've lowered the corporate tax rate to 21%, and it's a flat rate, 21%. Okay, so instead of Apple having to pay 35%, they're going to have to pay what? They're going to have to pay 21% going forward. That's a pretty nice tax cut, right? Okay, now what they're saying with the lowering of these corporate tax rates, okay, which has required them to ask people in California, individuals in California, to pay more. They're saying that what will happen as a result of these lower corporate tax rates is that the corporations will have more cash on hand, right? Because they paid less tax. And they will use that additional cash to do what? Pay higher wages. So the idea is, even though unemployment is at historically low rates right now, they're saying that wages are stagnant, right? So the idea is that if you give corporations more cash, they'll use that cash to turn around and increase the wages, right? Do you think that's what will happen? Well, let me ask you this. Can they do anything else with that extra cash besides pay higher wages? What else could they do with it? Huh? Give the CEO more money. Maybe invest, and maybe invest will have a multiplier effect, right? They buy more equipment. You work in the equipment making factory. Now you have a job, right? So it could have that effect. But are there other things that they could do with it? Huh? They could continue to stockpile cash, which they've been doing since what? Since it's about 2008. They keep piling up more and more cash, so they could continue to pile it. But let's say, you're a CEO of a big company and you're sitting there going, man, what are we going to do with all this cash? When you sit down for lunch, you got to throw a bunch of cash off the table so you can sit down and eat lunch. You're wiping your face with $50 bills, So I would almost sound like a rap tune, right? Wiping my face with $50 bills, right? Okay, so what's going to happen? You're living the life, right? So what are you going to do with all that cash? What else could you do with it? Thank you. That's what I'm thinking, all right? You can buy back your own stock in the form of treasury stock, right? So you buy back your own stock, right? What happens when you buy back your own stock? You supply and demand. You've increased the demand. The stock price will go up. You just increased the wealth of your shareholders, didn't you? And you increase the wealth of your shareholders in a manner where if they've held that stock over a certain amount of time, they get a better tax rate. They get a capital gains tax rate, which is lower than the rates that we're seeing here on the schedule. So you could distribute the wealth to your shareholders in a manner that's going to what? Give them a better tax advantage, increase their wealth, etc., right? So hopefully lowering this rate, and I didn't listen carefully enough. I heard that Apple is getting involved in something new venture that's supposedly going to be helpful for creating jobs and stuff. So maybe it will create that sort of a phenomenon. We'll hope. We have to wait and see, right? Okay. All right. So just a flat rate, and again, we'll get into federal corporate tax more towards the end of the course after the second midterm. Okay. All right. So we're going to talk about a few different things here. We're going to talk about marginal rate, average tax rate, and effective tax rate. What time do we get out? God, I got to stop talking. Okay. Marginal, average, and effective. I used to do presentations for colleagues. She would ask me every now and then to come in and do presentations about the CPA exam and stuff. And she'd say, yeah, John, can you talk for 2 hours? And I'm like, 2 hours? What am I going to talk about for? Well, I scheduled it for 2 hours. I'm going to talk about for 2 hours. She said, I think you'll think of something. Don't worry about it. And towards the end, I'd be trying to fill out I'd have the whole 2 hours filled out, and I'd run out of time. So she would always laugh. Don't worry. You'll find things to talk about. Okay, so anyway. So let's just take a look at Bill and Mercedes. And they have $160,000 of taxable income. An additional $10,000 of non-taxable income. Now, guys, we're going to study this more later, but there is some income that the federal government does not tax, and in some cases, it's because they are constitutionally not allowed to tax certain amounts. For example, can the federal government tax interest on state and local bonds? Can they tax interest on state and local bonds? Or do they? Let me just ask, do they? They do not. If you get interest from a bond for the city of Hayward issues bonds, don't buy them. If city of Hayward issues bonds, don't buy them. Okay, but I'm born and raised in Hayward, so I'm going to tease Hayward. I'll leave Stockton alone today. Okay, so if the city of Hayward issues bonds, what? Don't buy them. You buy them, I should say, and you get the interest on that, right? The federal government cannot tax that interest because the Constitution says that the federal government will pass no law that interferes with the revenue generating activity of the states. And by the states, that includes the local governments as well. So if they were to tax the interest on those, they would do what? They would be in violation of the Constitution. So is there a way that we can change the Constitution so we can tax those? How would we amend the Constitution? We put an amendment to the Constitution so that we can tax the interest on state and local revenues, right? Okay, so what would happen? It would have to pass the House and the Senate by 2/3 majority for the amendment, and then we would have to go to 2/3 of the state legislatures and get them, or is it 3/4? 3/4, excuse me, of the state legislatures to get them to vote in favor of the amendment to the Constitution. Why on earth would the states vote to approve an amendment to the Constitution that will cause there to be interference in their revenue generating activity? So of all the amendments to the Constitution, that's kind of like in the real safe category, okay, that it'll never get changed, okay? So they're having this $10,000 of non-taxable income, and so I'm thinking that might be interest on state and local bonds, whatever, okay? So using the 2016 married filing jointly tax rates, what is their tax due, their average tax rate, and the effective tax rate. And then we'll also talk about marginal tax rate if they got an additional $80,000. Okay, so tax due is pretty easy. You go ahead and they made what? We take this, it's $31,684, and since they made $160,000, and let's see if I can make the schedule a little bit bigger here, or I'll just go back to the schedule. I was going to try to do it on the same page, but I'll just go back here. So they made what? They made $160,000. So they're what? They're more than $91,000, but they are less than $191,650, right? So they have to pay at least $18,713.75 plus 28% of the amount over that lower threshold, right? Okay, so we go back and we see that when we calculated it, it was the what? The $29,752.50, right? That's that. Oh, sorry, I'm on the 2016 schedule. I need to be on the 2017. Huh? Oh, okay, thank you. And I need to be on the right schedule here too. So it's what? Between 75,000 and between 153 and 233, and 28% of the amount over 153. Thank you. Okay, so you come over and you just take a look, and they took the amount that they were over the lower end of the threshold, the 153. Okay, it's a little bit hard to see, but the amount they were over the threshold, and they took 28% of that plus that what? 29,752? Where's it? 29,752? What did I do? Use the 2016 schedule? Yeah, this is 2016. On 2017, it would be that other amount. So it's the 29,752 plus 28% of the amount over the lower amount of 153,100. It gets hard to kind of get all this on one page here so we can do it properly. Okay, so you can see the calculation there. Now for the average tax rate, they're simply going to take the amount of tax that they paid and divide that by whatever their income was. So since they have 160,000 of taxable income, whatever their taxable income was, that gives us the average. Okay. Now, effective rate is a little different. With the effective rate, we go ahead and we include non-taxable amounts after deductions, etc. We go ahead and we increase the base, don't we? So that we have a lower effective rate when you consider all of their income. Okay. Now, this is interesting because when they were getting ready to pass the change in the tax law, they kept on saying that the United States had the highest tax rates in the world. And when you compared them to other countries, the corporate tax rates, the tax rates that you saw in the tax rate schedules were pretty high compared to other countries. But if you looked at the effective tax rate, the United States was actually lower because of all the different deductions, etc. The effective tax rate is actually lower in the United States than it is in other countries. And of course, it'll go down even further with the 21%. And then after you still consider certain deductions, etc., the effective tax rate will probably be even lower. Okay? Okay, so we've got what? We've got the tax due. We've got the average rate, which is what they've paid, divided by their taxable income. You have the effective rate, which is after you've considered deductions, etc. You add those back, so on all their income, what was the tax that they paid? Now, we also have something called marginal rate. And marginal rate is what is the tax on any increases in your income. Okay, so what happens? For the marginal rate, notice that we go ahead and we take the increase. So they went from what? They went from 160 to 240, so they had an $80,000 increase, and then we're just going to compute the tax on that increment. Okay, so what happens? You come over and you go back over to the tax rate schedule, but now you're just going to look at the increment here that they had, which is this increase in tax from 54,417 to 131,684. So the additional tax that they're going to have to pay divided by the increase gives you the marginal rate that they had to pay on that tax. So they went from paying a tax of 31,684 to having to pay tax of 54,417. And that 54,417 came up because now their income is at what? Sitting here at 240. So they're in this range now, and so they need to pay what? The 51,791. What am I looking at? The 2016 schedule again. But on the 2017 schedule, they have to pay an additional tax of the difference between 54,417 and the 31,684. That gives you the increase in their tax divided by the increase in their income, and that's the marginal rate. And it would have helped if I didn't have the 2016 schedule there instead of the 2017, because those calculations were on the 2017 schedules here, which you can see right here that once they got into these higher levels, they had to pay that higher tax rate. Okay. Question? Okay. What we'll do is we'll get into some of these other things next time, which will go pretty quick. But what I want you to do, since we're sort of running out of time here, is go ahead and start on the homework. And when I say homework, I mean the homework that's in the chapter here. The chapter 1 homework. And you see that it's testing some of these, the quiz here, that it's testing some of these. So you can start to look at this. And what we'll do is we'll start with this probably next time and then go back and pick up some of those slides that we dealt with, that we didn't deal with, that we didn't get to this last time, and then we'll get ourselves into chapter 2. Okay? All right. Any questions, guys? Yes, sir.
So can you explain the difference between tax table and
Tax rate schedules?
schedule?
Yeah.
And one's a category, right? And one's just what you
They're still broken up by category. So if you look here at this is the tax rate schedules. Okay, but if we had the tax table, and I'm just going to Google it for you real quick. Hopefully I got connectivity, so you can just see what the tax table looks like. And I'll just do it. Yeah, tax tables 2017. And let's see, with the tax table, what they do here, and if they wouldn't put these watermarks on it, it'd be a little easier. They still give you the categories, but what they simply do is they say if you have taxable income of certain amount, your tax is, and they just call out the tax to you. So rather than sit there and have to do that, this amount plus the percentage over the lower threshold, and you calculate it, they just give you the amount on the tax table. It's slightly less accurate, yeah, right? Because the tax tables are doing what the tax rate schedule is doing. It's just that IRS went ahead and did it for you. But of course, there's going to be always, decimal differences. And if you're Apple and you made, $1 billion last year, those little differences could add up, right? So it's more professional to use the tax rate schedule than the tax table. But you could use the tax table. IRS won't, throw you in jail if you use the tax table. Okay. And when you look at the homework, guys, I think it'll be a little easier for us when we do the homework to see the way the tax tables work, because I've given you some problems to work with there. So use the tables to work with the problems. And what we'll do next time is figure out a way to have the table up while we work the problem, so I'm not sitting here trying to click back and forth and figure out where I'm at on the table. So we'll put those up and we'll get a little smoother on that. Okay, but go ahead and practice with those. I think you'll see they're pretty easy. Okay. All right, guys, and I'm going to go ahead and hopefully this thing was working the whole time, and I will go ahead and post it up. Okay.